At the end of 2010, 1,082 American funds set out to beat the stock market on your behalf. Everyone was run by professionals. Everyone had a strategy, a research team, and a very good reason to believe they were right. Half of them never made it to the finish line, quietly closed, or folded into another fund, and never mentioned again. Of the 1,082 that started, 109 beat the market. 109 out of 1,082, over 15 years. Now, you probably already knew it would come out something like that. You've heard it before. Index funds win, most managers lose. And yet, look at what you actually own. Somewhere in there is a fund with a manager, or 5 stocks you picked yourself because you had a feeling. Believing the slogan didn't change what you bought. So the real question isn't whether managers lose. It's why knowing that never seems to stop us. And the answer is sitting right there, in those 109, because they're real. Somebody did win. And as long as you can't explain them, you will keep looking for them. Here's the first thing to notice. This is the only part of the picture you were ever shown. The 535 that died don't run advertisements. They don't publish a 15-year record. They just aren't there anymore. And watch what that does to the arithmetic. 1 in 5 of the funds that survived beat the market, but only 1 in 10 of the funds that started. The whole difference between those two numbers is made of funds you never heard about. And a fund that closed cannot have beaten the market over 15 years. It wasn't there for 15 years. That isn't a technicality. That is the point. Now, when a fund shows you a beautiful 5-year record, your brain does something very fast, very reasonable. It says, that looks like skill. It looks like skill, but so does luck. And so does a style that simply happened to be in fashion. From the outside, all 3 look identical. So let's build the cheapest fund managers in the world. 1,000 of them. No research, no strategy, no skill at all. Each one flips a coin once a year. Heads, they beat the market. Tails, they don't. After 1 year, about 500 are beating the market. After 2, 250. After 3, 125. After 4, 62. And after 5 years, about 31 of these coins are sitting on a perfect record. 5 years, 5 wins, no losses. 31 geniuses, made entirely out of nothing. And those are exactly the 31 you'd see in the advertisement. And I was being generous. I handed them a fair coin. In the real world, the coin is bent before they flip it. Fees, trading costs, cash sitting idle. Which is why over 15 years it wasn't 1 in 2 who made it. It was 1 in 10. Generous a second time too. Real managers don't flip independently. When one style is in fashion, every manager holding it wins at the same time. A 5-year streak can be a style, which is worse than luck, because styles reverse. In the real world, over 20 years, 93% of active large-cap funds lost to the S&P 500. After fees. Adjust for the risk they took to try. Same 20 years, and it's 98. And it isn't a photo finish. Over those 20 years, the index compounded at about 11% a year. The average active fund, under 9. But none of that tells you why. And they're bad at their jobs is not an answer. These are not stupid people. Fees. We did that math last episode. The average active dollar simply cannot beat the market it is. And after costs, it earns less. But fees alone would only push about half of them below the line. Not 9 in 10. Something else is doing the rest of the work. Here it is. Since 1926, about 57% of every U.S. listed stock, roughly 4 in 7, returned less over its entire lifetime than a 1-month treasury bill. The best 4% of companies account for the entire net gain of the U.S. market. Everything else, altogether, did about as well as Treasury bills. So the market's return isn't spread out, it's piled up in a handful of names. And to beat the index, a manager has to be different from it, which means underweighting something, when almost all the gain is hiding in a few names. The odds that the one you left out was one of them are brutal. That's the honest answer. The index fund doesn't beat him because it's smarter. It beats him because it never has to choose. It holds the winners at full weight, from day one, by default, and it doesn't charge you for the privilege of guessing. Now, the case against everything I just said. It's stronger than people admit. 1. The arithmetic only says the average active dollar must lose. It does not say nobody can win. Somebody has to be on the other side of every trade. Skill could be real and rare. Fair. So, can you find them in advance? Take the large cap funds in the top quarter at the end of 2021. 4 years later, the number still in the top quarter was 0. Not a few. 0. And of the ones that merely stayed above average, 4.5% managed it, when pure chance predicts 6. Worse than a coin, and that's S&P's own conclusion, not mine. When outperformance shows up, it tends to be luck rather than genuine skill. 2. Those managers are the ones setting the prices. The index just accepts whatever price they arrive at. If everybody indexed, there'd be nothing left to copy. Index investors are, in a real sense, free riders, and that's a real debt, even if the ride is a good deal. 3. And this is the one that should bother you most. These were the best 15 years cap weighting will ever have. A handful of giants carried the index. And an active manager is structurally forbidden from holding them at full weight. Position limits, concentration rules, valuation discipline. Some of that 90% isn't a verdict on skill, it's a verdict on position limits. Maybe, but to act on that, you'd have to know in advance when the regime turns, which is the exact guess you were trying to get out of. And it cuts both ways. Owning the market means owning that concentration. On purpose. Cap weighting was never a promise of balance. It's a promise of ownership. You get the market exactly as it is. So, don't buy a track record. A great track record is precisely what luck looks like, from the outside. As Bogle put it, don't look for the needle. Buy the haystack. Own the whole thing, and you own the 4%, without ever having to find them. And those 109 who won, you can only point at them now, looking backwards. At the end of 2010, on the one thing you would actually have looked at, the track record, they were indistinguishable from the 973 who weren't.